You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back. Welcome back, Hamish. How you been? What you been up to? Same old, I'm guessing.
Yeah, same old. Nothing new to report here.
We need more interesting lives.
I know. Just another week in full lockdown. Went out once this week. Went grocery shopping.
Yeah, that's true. I forget you're in Melbourne. What are the rules at the moment?
There's a lot of rules, but only one person per household can go out if you're going to get groceries or anything like that. You can only go out once per day. There's an 8 p.m. curfew, so after 8 p.m. you can't leave your house.
Really?
So there's a lot of rules. To your maximum of exercising with 2 people, so with one other person. Yeah.
Wow.
So
I wonder how does a curfew help? I don't really understand that.
Yeah, that's a good question. I don't know. I guess because maybe in the evenings, that's when a lot of people would be maybe breaking the rules and having a party or something like that.
Maybe socializing.
So, because then if it's 10 p.m. at night and there's a curfew and you go out on the street, I presume there'd be very little cars out there. So it's very easy to identify if someone's not doing the wrong thing.
There you go.
So I guess that maybe, but I don't really know. Yeah. So it's been, besides going out, walking around the block and once for groceries, it's just been
Sounds
sheltered.
Depressing, to be honest.
Yeah. I mean, even for someone as introverted as myself, I do love staying in, but even for someone like me, it's very challenging to do it. I can't imagine what it's like for people who hate staying inside and always want to go out. It's been a wild ride, but this week, nothing to report. How about yourself?
So you're still allowed to work, right? Like if you're a gardener and all of your work is outdoors, you're still allowed to do that, right?
Well, there's only essential work that's allowed.
Oh, geez.
Yeah. So
it's worse than I thought.
I think most things are closed at the moment. So.
Oh, right. There you go.
Yeah.
Well, I hope that Victorians can kind of get on top of it because, for your sake, jeez.
Yeah,
it's such a stark difference because here in the ACT, we've currently got no active cases and there's basically no restrictions whatsoever, and we're just kind of strolling around like whatever. Yeah, sorry to rub that in a little bit.
Yeah, geez. Wow. Make me feel good.
Luxury.
Yeah, actually, that was something interesting this week. New Zealand, they had their first case in 100 days or something.
Oh, serious?
And they went straight back into lockdown. They're not messing around at all. So I think they had 2 or 3 cases or something for the first time it was 102 days or something like that.
That's crazy.
Yeah.
Maybe some people just thought it was a cold, didn't get it looked at because they thought that there was just no virus in New Zealand or something. But that's insane. I guess if 2 or 3 people have got it, then that's definitely positive. But if just one person had it, I'd question the test. I'd wonder if it was a false positive.
Yeah, that's true. Or it could just be someone that just came back from overseas, I guess.
Oh yeah, true. Because they're still allowing New Zealanders back into their country, I suppose.
Yeah, you would imagine so.
Just no other travel, I suppose. Anyway.
Very bleak way to start this podcast.
What a bleak podcast. Oh dear. I feel sorry for you Victorians. Anyway, let's get into this sponsor and we'll get stuck into it. We've got a lot to talk about today, so let's get going.
Yeah, we do. So today's episode is sponsored by Sharesight. Sharesight is an application that you can use to track the performance of your stock portfolio. It's great for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you are buying shares internationally or you hold foreign currencies. And then the main reason why I use it and the other other thing that you can use it for is for when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. And they also have a free plan that you can use forever. So go check it out if you're interested.
Yep. Also, before we get going, we should say sorry about last week with the podcast. It came out a little bit late last week.
Yes.
We just had an issue with the edit, but it was just a once-off issue. Well, we hope. We hope it was a once-off issue, so we should be all back to normal this week. So sorry, I know a couple of people commented saying that they were eagerly awaiting the podcast to come out on the Saturday morning. And when did it end up going up? It was like Saturday night, I think.
Yeah, it was maybe 5 or 6 p.m. or something like that. Yeah.
Yeah. So sorry about that. We were working hard to try and get it out as soon as possible. But yeah, we just ran into some issues, but we should be all good from here. All right, well, let's get stuck into it. First thing I wanted to just something that caught my attention. This is not really too much of a news story to talk about, but Apple, it's closing in on being the first $2 trillion company.
Wow, really?
How insane is that? The craziest thing to me is that I feel like it wasn't that long ago where we were doing a podcast and we were saying Apple is closing in on being the first $1 trillion company.
Yeah, I'm just trying to go back and have a look. So the stock price at the moment is $450, and that's just below 2 trillion. So what would that be? 225 or something like that. Yeah. So when did they first hit that? Let's have a look. October of 2019.
Yeah.
Wow, that's not even a year.
It's been a year. Holy smokes. So their current market cap is currently $1.93 trillion. That is crazy. It's up 101% since March the 23rd when everything started turning around.
That's crazy.
Yeah, it's a big earner. Yeah. And remember, Warren Buffett, he didn't even buy this stock all that long ago. I think, what was it, like 2016?
Yeah, I think it was 2015 when he started.
Yeah, right. So he's owned it for 4 or 5 years.
Yeah.
And I remember he was getting in around $100 a share, $120, $130 a share.
Yeah.
He'd be sitting very pretty. And he bought big into Apple too.
Yeah, he owns a lot of stock in Apple. I don't know what
massive.
It's worth now.
It's a huge position.
Yeah, it's crazy. It's been
So he'd be sitting pretty on that, that's for sure.
Yeah. Is Apple the biggest company in the world at the moment? They must be, right?
Surely. Yeah, otherwise the headline would be another company is closing in on being the first 2 trillion.
True.
Maybe this is it. The only other one that could rival it, what's Saudi Aramco?
Ah, that's right.
You remember that big oil one that had the massive IPO?
Saudi Aramco. Let's have a look.
Yeah, I'm having a look at it as well.
Oh, no. They're
what the hell?
Yeah,
I can't find it. Anyway.
Research.
Maybe that was just the biggest IPO.
Yes, that might have been what that was. Yeah.
Yeah, I can't remember. Anyway,
not important.
But yeah, pretty insane. And I wanted to talk about a little bit more on some of these big companies in the S&P 500 because while Apple is just on an absolute tear, a lot of the other really big companies in the S&P 500 are also on an absolute tear. And this is really interesting because you know how we're heading into Q2 earnings and we weren't really sure which way it was going to go because Q2 was really the point where everything got shut down over in the United States. They had quite a percentage of Q2 was just in basically lockdown. So we were thinking, earnings really going to be that great. So I had a look at, and I did this in one of my recent videos, I had a look at the top 10 companies in the S&P 500. And I just looked at what their Q2 earnings were this year versus what their Q2 earnings were last year. So looking at year over year revenue growth, okay? And then for the top 10 in the S&P 500, we've got Microsoft was up 12.8%. Apple was up 10.8%, Amazon up 40.2%, Google was down 1.8%, Facebook was up 10.7%, Berkshire down 10.6%, Johnson & Johnson down 11, Visa down 17, and Procter & Gamble up 3.5. So actually, when you look at it, I should say as well that I only said 9 stocks there, and that's because Google gets counted twice because, I don't know, their A shares get counted, then their C shares get counted. But what I find really interesting is just these massive stocks, techie stocks in the US, some of the biggest companies in the world, and everyone's kind of doom and glooming it and saying they're going to do terribly. And they actually most of them performed really, really well.
Yeah, it's a really strange environment where the biggest companies in the world at the moment are also companies that they're kind of the types of businesses that do well in the current situation we're in. We're kind of in this very unique economic downturn where everyone's stuck at home. And then there's all of these internet services that are doing quite well. In fact, I mean, Amazon up 40%, and that just makes sense. I mean, people don't want to go out as much, and I would imagine that the businesses you just mentioned make up a significant part of the overall index.
About 25%.
Wow. Yeah. So it's crazy.
Sizable chunk.
Yeah.
Yeah, no, it's pretty insane just how well a lot of these companies have performed. And I mean, that goes a long way. Like these companies, 25% of the S&P 500, that goes a long way to ensuring the price stability of the S&P 500.
Yeah.
Because I mean, even if a lot of the other 75% didn't do very well in Q2 because they're just, I don't know, maybe pretty standard businesses, physical kind of retail-y kind of business or something else, I don't know, then it's still nice having kind of 25% of that index performing pretty decently. I guess it just kind of holds up the stability of the price. It just makes sure that, I suppose, it's less likely that S&P price is going to crash because, 25% is actually pretty solid.
Yeah, and I mean, it kind of then makes a little bit more sense why you have this massive difference between the performance of the index and what's happening in the actual economy, because the actual economy, which is mostly a lot of smaller businesses, a lot of them that are struggling, is really made up. It has a very different makeup to the S&P 500 index, which is concentrated so greatly in these businesses that are doing so well while a lot of other businesses are struggling. So it's a fascinating turn of events outcome, I guess. Not turn of events.
Yeah, and the other thing to consider as well is that you think about, the economy, that's more based in numbers like GDP, unemployment, blah, blah, blah. So yeah, those like GDP has been going down. But that's, of course, for the United States. Whereas you could assume, like, a lot of these companies make a fair amount of money outside of the United States as well. But I guess their international revenue doesn't get counted as home ground GDP, does it?
I don't know.
I don't know. I'm not sure.
Yeah, I'm not sure, because I know that in GDP they do take into account imports and exports.
Right.
How that plays into someone like Google, where they might, you might consider that they're exporting or importing, exporting advertising space or something like that. I'm not sure how that. Yeah, I'm not sure how that sort of plays in this realm.
If you know, let us know in the comments of the YouTube version of the podcast, because I'd be interested. Because I'm not sure about that. But yeah, I guess the point I was making is it's very interesting because these companies are performing well. But you're right, the economy, GDP is going down, unemployment's going up, so the economy is looking on shaky ground. So anyway, that's where I wanted to leave that one. Pretty crazy overall. Q2 actually turned out to be pretty decent.
Yeah. All right. Should we talk about Uber? What's happening with Uber and Lyft this week?
Yeah. What is going on? I don't know.
This is a big story, and this is not one that I was following. I was following it a while ago, but I'd completely forgotten about it until I saw a new story that came out this week. So, the headline this week was that a California judge issued an injunction that stops Uber and Lyft classifying drivers as contractors in California.
Wow.
So I'll give a bit of a summary of what sort of happened leading up to this moment, and then maybe explain what are the consequences of what's about to happen.
Yep.
But basically, there's been a really long legal battle between the state of California and the two ride-sharing apps, Uber and Lyft, in California. So this sort of all started on January 1st of this year, where California passed new laws that essentially made it harder for companies to classify their workers as contractors. So really this move was to get more workers to be classified as employees and therefore guarantee more workers things such as the minimum wage and sick leave. So obviously at the moment, companies like Uber, they just contract their drivers, right? And as a result, they don't need to pay them minimum wage. They don't need to give them sick leave and other benefits, healthcare and that sort of thing in the United States. And basically the state ended up, so they passed that law, and then obviously Uber and Lyft did nothing. They just continued to use their drivers, or classify their drivers, I should say, as contractors. And then the state ended up suing Uber and Lyft in May. So that's quite recent. And they were suing them because they were breaking that law. They were continuing to operate their drivers as contractors. And then as recently as Tuesday, a judge issued an injunction, which essentially is an order to an injunction is an order to either compel or prevent someone from doing something. And in this case, they're compelling Uber and Lyft to classify their drivers in California as employees. So that's really big news, because there is a big cost expense difference between having someone as a contractor where there's no minimum wage, there's no sick leave, there's no healthcare or anything like that they need to provide. There's a big cost difference between having to provide those. So it's a very big deal for both of those companies.
Yeah, this is, to be honest, I don't quite understand this, because I don't think, when I think about the business model and I think about Uber drivers and Lyft drivers, I don't really think that they are employees. I mean, that's the whole point, is that Uber or Lyft or whatever has built this app, this kind of, I suppose you can call it this taxi, ride sharing app. And then they say, you know what, we just offer this service. It's a service that connects a supply and a demand, right? It's a service. It's just like a middleman. It connects someone that needs a ride and it connects someone that wants to give a ride. I don't see Uber drivers as Uber employees. I see them I just see Uber as offering that platform where they can connect those two parties. Because I'm just thinking about the rules here in Australia. I mean, if this happened in Australia, what are Uber drivers going to do? Are they going to go in and sign a contract and say, yes, I'm a part-time employee, I work the hours X till X?
Yeah,
or
exactly.
I'm a full-time employee, I work from, 9 to 5. And
do you clock in and out?
Yeah, exactly right. How much flex time do I like? It just, to me, the structure of being an employee doesn't work with what the Uber or Lyft app is trying to accomplish, is trying to offer. I think about Uber and Lyft as just like, if I wanted to be an Uber driver, this is fantastic. It's totally on me. I get to wake up and I can choose to go to work. I can choose not to work. I can choose to do this, choose to do that. I mean, it wouldn't make sense. It's like, I got to wake up and now I've got to go drive 9 hours for Uber. And, if I'm not working today, I might have to chuck a sickie, call them in and take up some of my sick leave. It just doesn't make sense to me in that aspect.
No, I mean, it doesn't make really any sense, because the other thing is that the app would be providing the drivers with how much demand there is in the area, which would then dictate how many people actually go out and drive if the rates are really high in that particular moment, rather than them just, showing up to their morning shift of being an Uber driver. So it's really strange. I don't have on me I don't have it written here, the legislation that actually was passed, but I did briefly look at it. The change that they made in January, and it's very, very rigid. So one of the, so in other words, I think it does, the legislation makes it seem as though Uber and Lyft will have to classify their drivers as employees. Like one of the parts of the legislation was that, is it an essential part of their business, like a central part of their operations? And I mean, it certainly is. It's like the core of their business is those drivers. So Very interesting to see what happens. The judge also gave them 10 days to comply, so it wasn't in effect immediately. And in practice, what that means is it's time to allow Uber and Lyft to file an appeal. Both companies said immediately that they intend on appealing, which means that no changes are going to happen in 10 days. Basically, they'll appeal it. They haven't done it yet, but they will appeal it. And then we'll have to wait until that appeal is heard in the courts to find out what happens. The last thing I just wanted to mention on this was that an Uber spokesperson basically said, and this is their position, when over 3 million Californians are without a job, our elected leaders should be focused on creating work, not trying to shut down an entire industry during an economic depression. And I think that's the way I see it. It would be great if all driving jobs were unaffected. It would be great if the drivers could be compensated better. But I just don't see an environment in which Uber and Lyft can operate if they have to classify the drivers as employees. Yeah, exactly. It just doesn't seem feasible. So I guess we'll kind of see what happens.
I totally agree with that quote as well from that Uber spokesperson. I mean, that's what I think about. This is why I think Uber is so great, is that they build a platform that enables anyone, as long as you can drive and you've got a fairly up-to-date car. If you tick those criteria and you sign up with Uber, you have just created a job for yourself.
Yeah.
I mean, it's great. I mean, it's just an enabler of employment. I mean, why do you want to mess around with that? I totally agree with that.
Yeah.
Oh, dear. I don't know. I think this would be really interesting if people head over and drop a comment on what you think about this whole situation. Do you reckon that Uber and Lyft and all these other ones should be classing their drivers as employees, or do you think it just doesn't work and they should just stay as these contractors and, get to make their own decisions about their work? I'd be interesting to hear what the audience says, because obviously we've got our own opinions and you probably have yours as well. So weigh in on the conversation and let us know.
Yeah, absolutely. I guess the other thing to mention is also, even if the state wins this is only in California, and California is their biggest market in the world.
Yeah.
But it's still a small slice of their global business. So, overall, investors don't seem too worried. Uber stock was only down 3% on the news, and Lyft stock was down 1.3%. So nothing too much.
But you know what it's going to turn into, though? At the moment, it's going to be California. And then another state will do it. And then another state will do it. And then another country will do it. It's kind of like when, I can't even remember what the first state was to legalize marijuana. And then it's just like, and then another state does it. Oh, and then another state. And now another country's considering it. And then all of a sudden it's kind of this snowball effect.
The dominoes fall. Yeah.
Yeah, exactly right. So, yeah, geez, I don't know about this. Yeah. I don't know. It's a pretty weird one. I think I would need to understand the rules a bit more in depth to make a truly informed decision on it. Like, how could it be structured if you were an employee? How would it be structured differently and whatever?
Yeah, definitely.
Yeah. Anyway,
all right.
Should we move on?
Yeah. Should we move into some earnings now?
Yeah, we do have some earnings. I thought I'd chuck in Disney. I think Disney reported this week, or maybe it was last week and we just didn't get to it. We didn't talk about it last week, did we?
No, we didn't. No,
we didn't. Okay, so maybe it was in last week. Yeah, so I wanted to include Disney. We didn't talk about Disney last week, so I thought that we should chuck it in this week. This is obviously a global entertainment company, which we'll talk about a little bit more in a second, the different parts of their business, but definitely a company that's been impacted quite heavily from the shutdown. I was just reading diluted earnings per share for the quarter decreased 94% to just 8 cents from $1.34 in the prior year quarter, so in Q2 2019. So yeah, man, that's pretty rough.
That's
poor old Disney. They've copped a big hit. They said in their earnings release that the most significant impact was at the parks, experiences and products segment, as most of our theme parks and resorts were closed for the entire quarter, and our cruise ship sailings were suspended.
Right, that makes a lot of sense. They probably have a ton of expenses that are related to those that they can't cut easily. So when their revenue just stops, there's just huge losses in those areas. That's what I would assume, at least.
Yeah, definitely. That would definitely be the highest expense part of their business, I suppose. And it's also the second biggest contributing segment to their revenue and their earnings. So it's a big one to miss. It definitely goes a long way to having the poor results that Disney have showed.
Yeah.
However, there was a shining light out of the earnings, so it wasn't all bad because like Netflix, you know how Netflix was adding just a heap of subscribers to their platform because everyone was stuck at home?
Yeah.
Exact same thing happened for Disney. So they say that the global reach of our full portfolio of direct-to-consumer services now exceeds an astounding 100 million paid subscriptions, a significant milestone and a reaffirmation of our direct-to-consumer strategy.
Hang on a second. 100 million paid subscribers.
Yeah, 100 million.
What?
100 million.
I think they were only at 50 or so just 6 months ago.
But that was just Disney Plus.
Right. Yeah.
That 50 million you're remembering is when they said that, you know, after the launch, they had a couple of months of launch and then they came out and said, Disney Plus is doing so great, 50 million subscribers.
Oh, okay. So yeah.
Remember that Disney has the three streaming services. They've got ESPN Plus, Hulu, and Disney Plus.
Right, okay.
Disney Plus is still definitely the biggest.
Yeah.
Hulu's second biggest. ESPN Plus is not very large. But yeah, overall, I mean, if you're looking at Disney as a investment, as a company, then you want to factor in all three. So
of course,
100 million total, which is pretty impressive. I'm just looking down here. I wrote how that compares to Netflix. That's right. Netflix is at 193 million.
Wow. Okay. So, I mean, that's pretty good. I mean, when did Disney Plus launch? Not very long ago.
Late last year.
So
yeah.
They've done a great job. Hulu's a big service, 35.5 million.
Yeah. So we got Disney Plus is at 57.5 million, ESPN Plus is at 8.5 million, and Hulu's at 35.5 million.
That's great.
Yep. So a total of 101.5 million paid subscriptions.
Watch out, Netflix.
Crazy. Yeah, and really interestingly, generally speaking, the subscriptions are cheap to the Disney platform. So I was just looking at the monthly revenue per subscriber, and Disney Plus is at $4.62, ESPN Plus $4.18, and Hulu for streaming video on demand was $11.39, so a bit more expensive. But you compare that with a Netflix. Netflix costs a bit more. Amazon costs a bit more. Disney are definitely going the undercut.
Yeah, I would imagine Netflix in US dollars would be about 10 or something like that.
Probably,
maybe 8 or something like that. Yeah. So I guess that's something to consider, right? Is that is part of the reason why they've been able to grow so many users, so many subscribers on Disney Plus, for example, is part of that because it's so cheap. If they bring that price up, if they were to bring that price up equal with Netflix, would they see a decrease in subscribers? That would be something that will be interesting to watch, because if they can increase prices substantially and get in line with Netflix or even above Netflix, and they still see subscriber growth, I think that's probably a good indication that they have some kind of, distinct advantage.
Special.
Yeah, something special that people are willing to pay extra for.
Yeah, I agree, but I don't think they will.
Oh, I don't think they will.
I think that they do that because we've spoken about that before, because I think they're deliberately doing this to gain as much market share as quickly as possible.
100%. Yeah, completely hypothetical, what I just explained then.
Yeah. Because they're definitely leveraging the fact that they make money in 3 other segments to really target direct to consumer. Because they could basically run it profitably if they wanted to, but they choose not to. And I think that's just for a big market share grab. I think it's a better strategy to establish your subscribers, and once you've established that subscription base, slowly bump up prices, as opposed to coming in hot with a higher price and just hoping that makes you profitable straight away, especially when you don't need to be profitable straight away.
Yep. The same thing is true for even something like a Facebook that was not profitable for a very, very long time, didn't have any ads on the platform for a very long time, because that was what was required to attract as many people as possible. And then once you've got them, they're not going anywhere. So then you can start pumping out the ads. The same thing is true for something like this. Get people in, and once you get them in, I mean, you can tell that once you just get someone subscribed, a lot of people just leave their subscriptions because, and you can tell because whenever you try and cancel one of these subscriptions, they're always giving you free months. They always just want to keep you in there, even if they're not generating revenue for the next month or so from you, because they know that it's likely you're going to hold on to it for a very long time.
Yep. It's actually remarkable. I mean, you think about like, this is not only, streaming services, you can think gyms, they just want to get you because once they've got you, most people forget to cancel. Like you stop going to the gym, a lot of people just forget to cancel their memberships. There's so many, I had another example, but I just forgot it. But there are so many examples of just like hooking people. You can think about, I don't know, Adobe Creative Cloud, hook them in. And even if you don't use it for a little while, maybe I'll get back into photo, maybe I'll get back into video editing. I might just keep my subscription.
Yeah.
So it's definitely the strategy is to hook them, get them signed up, because then even if they stop using the service, it's still less likely that they're going to cancel even if they don't use it anymore. The other example I was thinking is Audible.
I was just about to mention that.
Yeah. I mean, they go to a subscription model where you pay each month. I think it's like $16 or something like that.
Yeah, I was just going to say, for anyone who hasn't checked out Audible and you love reading books or listening to books, I should say, they have a free trial. At the end of the free trial or just before it, if you cancel, they give you another free trial. And
really?
From my experience, that just continues. So,
oh my gosh, free Audible.
So,
I've done this wrong, haven't I?
if you're thinking it was too expensive, you can get it for at least 6 months for free. So, there's a little hack for you.
That's all right. I'll make another email address, sign up again.
It's an interesting strategy, but I guess they just presume that one time you're going to forget to cancel it.
They've done the modeling. They've done the economics.
Yeah. They know the economics. They go lifetime value over the next 5 years. This person, $170 or whatever it is. We don't care if we don't make any money in the short term.
Yeah. All right. Getting back into Disney, I did want to go through their 4 different segments because we were talking about how they have been hit by the coronavirus. And I just touched before on how that quote out of their earnings, how their parks experiences and products were severely impacted. But this is their 4 different segments. So if you don't know, Disney makes money in 4 different ways. They've got their media networks, then they've got their parks experiences and products, then they've got their studio entertainment, and then they've got their direct to consumer. So if we have a look at year over year Q2 results, then media networks is only down by 2%. So it's basically flat. Then the parks experiences and products was down 85%. That was the one that really copped it. But also studio entertainment was down 55%. So that's the movies. And then direct to consumer was up by 2%. That's for revenue.
Yeah.
So.
That also, I mean, that makes sense. There's studio entertainment, right? Because a big part of revenue in that segment is selling to cinemas, selling the licensing to
box office.
Selling the licensing to cinemas, so box office. Yeah. So
exactly
with all of those or a substantial amount of them shut down, that's another part of their business. I didn't even think about that. That would be significantly
Production's
hurt.
Been hit. In fact, I really, really like Disney, their reporting, because they really take the time. They don't care if their reports go on forever, but they take the time to make sure they explain why things have happened as they have. That's what I really like. So in this earnings release, they literally said, this is all of the different ways how we have been hit from the coronavirus. And then they just went through and they listed them. So, for instance, first one, they said our parks and cruises are currently closed. Number one. Then because of that, a lot of our retail stores during the quarter were shut or, impacted. And that meant that we didn't sell as much merchandise. And then the next point is, delayed or in some cases shortened or cancelled theatrical releases and suspended stage play performances. Then the next one down was adverse impact on advertising sales at their media networks business and their direct-to-consumer business. Then the next point, we've experienced disruptions in the production and availability of content, including the deferral or cancellation of certain sports events and suspension of production of most film and television content. So they just take their time, and I just love them for it. Like, thank you for trying to inform your shareholders. This is exactly how we've been hit in the different areas of our business.
Yeah,
and they give numbers as well. They tell you exactly how much, exactly why. It's perfect. It's what you need to know.
Yeah, that's it's brilliant that they break it down, and it's great for someone who is really interested in the business and wants to dive through all of it. That's really awesome. One thing that I just noticed when you were reading through those things was I was looking at the revenues for direct to consumer and international, and I saw that it was only up 2%. And I was just about to ask, well, why is that only up 2% if they had such a huge increase in their in their revenue? I'm guessing in their revenue from their subscription services, but it obviously includes their international segment, which is a lot of advertising and licensing agreements that they have that are outside of the US. So obviously that would have put some downward pressure on it. But it kind of just shows that you can't just look at like the top surface numbers. You need to sort of dive into it and make sure you understand each segment so you know what's going on. Because that direct to consumer and international segment, it's kind of two very different businesses that are kind of put together, and then you get this number that's a 2% increase in revenue. Whereas if that had been broken out, I would presume that direct to consumer saw a big increase in revenue and international saw a substantial decrease. So
yeah.
All right. With that said, should we move into the other earnings report that we had this week, which is a big one? Berkshire Hathaway reported. Warren Buffett.
Yes. Big Warren's company. Love it.
Big Warren. We just call him
Big W.
We just call him Big Warren now from now on.
Big Warren.
Oh dear.
Why not? Big Buffett. Big Buffet.
Oh dear. Big Buffet. Oh dear.
Yeah.
Oh no.
Did I tell you? I'm sure I've mentioned this before. Warren Buffet has more hashtags than Warren Buffett.
Oh no.
Yeah, it's pretty funny,
sad.
isn't it?
Yeah. That's not good.
Yeah. It's just no one can spell his name right. Even when I got my new introduction for my channel done, that intro video, Buffett was spelt incorrectly in that to get him to go back and change it.
Oh, that's funny. Yeah, I just remembered a very long time ago, I made some post about Warren Buffett, and you messaged me and was like, by the way, it's 2 T's.
Yeah. I think I just picked that up. I think it was in your title of your video.
Yes, that must have been what it was. Yeah. Very funny.
Anyway,
how's
the business going?
Yeah. So, the first thing to mention is there's quite a lot of Berkshire's business that I don't quite understand. So I've kind of gone over quickly some of the major numbers just because it's not that interesting to me. Insurance and stuff, and I really don't understand it. But
just what insurance and railroads and other stuff, energy. And I think they're the 3 big dogs, aren't they?
Yeah, and I thought what was more interesting, at least for me, and I'm sure this is the case to a lot of other people, is how they allocated their cash. So what did Buffett do with his money, with the money that they generated? So that's where I'm going to focus mostly on. But in terms of their total revenue, it came in at $37 billion. And as you mentioned earlier, when we were talking about the biggest companies, that was down 10.6% year over year. Right. And I just had a quick look at sort of which segments went up, which ones went down. And the decreases mostly came from the insurance business, which is the largest part of their overall business. And within the insurance business, it was the sales and services revenue that was down 16% to $29 billion. So that's where most of the decrease came from in terms of their revenue. And there were some segments that were up. So insurance premiums, for example, were actually up slightly during the period, I'm pretty sure. Or maybe they were down slightly, but certainly not down 16%.
Drastically,
So, there was you can go check out all of the different segments, but there was nothing overly interesting that I thought that stood out to me. Yeah. In terms of their...
It's interesting that like in a shutdown situation, they've got just less sales of insurance. It's like, I would have thought that's one thing that people don't really cut. It's like, house insurance, that's gone down. I've decided not to insure my car this year.
Yeah, see, this is the part where I don't know enough about insurance to understand this.
Sure, there's more to it.
Because the premiums are up, right? It's this sales and services segment that's down. So I don't really know what that means.
We'd have to delve into it further.
Not enough research done on my part. But their net profit came in at $26.3 billion, which was up 88% Year of
Jesus.
year. So what happened there? Well, it's a little bit misleading. This includes this recent accounting change. I think it happened 2 years ago or something like that, maybe last year.
Years back.
Yeah. Which basically means in their net profit in the income statement, they now include unrealized gains on gains and losses on investments. So if you have stocks that go up, even if you don't sell them, or I should say if Berkshire has stock, if it goes up, even if they don't sell it, that gain is included as profit. Which, I mean, it's just ridiculous.
It's the dumbest rule. Like, you can understand the intention why they've changed that in the accounting, just so that, you know, when you read the reports, it is the most up-to-date positioning of the company as it stands right here, right now. You know, if you shut up shop and sold everything, then this is what it would be. But for a company like Berkshire, it doesn't really make sense overall, just because, I mean, we're talking about investments. And I mean, if you're making an investment, you're not gonna, you know, in most cases sell it within the next 3 months. I mean, especially in Berkshire Hathaway's case, if you're buying stocks, if you're buying positions in these large public companies, then, I mean, Warren Buffett, he wants to hold these stocks for decades. I mean, you think about what some of the ones he's made in the past, you know, whether it be like Coca-Cola or something else, he's held these stocks for so long. So even though he has to report he's basically reporting whether the stock has gone up or gone down, whether his portfolio has gone up or gone down in the previous 3 months, when realistically he's going to hold that portfolio for a very, very, very long time.
Yeah, the only world in which this makes sense, to me at least, is one where the market is completely efficient, or at least mostly efficient. So in other words, the changes in the stock price actually reflect the true value of the business, what that business will produce in the future. In that case, it makes sense, right? Because if you have
that's what it's worth.
Yeah, that's what it's worth. If you have a business that bought some stock and it's gone down, if that's actually what the business is worth, then they've taken a loss. They've taken a loss, really, even though they haven't locked it in. So
even though it's unrealized,
I guess that's really where you would disagree or agree that this rule makes sense. If you think that the market is mostly efficient, then it makes perfectly good sense. I just don't think that's the case. I don't think Buffett thinks that's the case either.
No, I think it's silly.
Yeah.
And it makes it harder. It makes it harder for us. Like, if we're looking into Berkshire Hathaway, I mean, it's just confusing. Imagine if you're looking into Berkshire for the first time, and then you just see this, you know, wild swing up or down, where you look at their segment operating income and it's like stable, and you're looking at net profit and it's going up 88%. You're like, what the hell? And then you got to try and figure it out, take those numbers out of the equation. But I don't know.
Messy.
Yeah, it's just frustrating. It's just annoying.
Yeah. All right. So we had, in terms of their balance sheet, so this starts to get into the stuff that I find interesting, which is how much cash did they gain, or did they run down, and what do they spend their money on, and that sort of thing. So their cash and cash equivalents at the end of the quarter was $146.6 billion.
Jesus Christ, that's a lot.
That is, it's a lot, and it's also up from 3 months ago. So 3 months ago, it was 137.2. So they've seen an increase in their cash. So they definitely haven't been buying more than, I guess, the cash that's coming in from their businesses, right? It's been building up. And then in terms of the cash flow statement, there was kind of two things that were of interest. So the first is that if you look in the investing activity section, there's a line that tells us how much did they outlay, so how much cash did they spend on buying equities, buying stocks, and how much came in. So it doesn't tell us what it is specifically, but the total amount. And during the quarter, there was proceeds from selling equities. So they sold equities and gained cash of $15.7 billion. And why this is interesting is because we know that about $6 billion of that is related to the sale of the airlines, which happened in April. So we know that about $6 billion of that's related to that. But since it's $15.7 billion, clearly Buffett has been, and Berkshire Hathaway has been selling something else. So that's the big question mark. We don't know what they're selling, and we'll actually have this answer very soon. And by the time you're seeing this podcast, you will be able to know. So you can probably do a Google search. What did Berkshire Hathaway sell in the last 3 months or whatever? Because
Yep.
The 13F filing, which tells us about those trades, comes out on the 14th of August. So
I see.
That comes out tomorrow or the next day from when we're recording this. But once you're seeing this podcast, it will be out. So
it'll be out.
Yeah.
Yep. I actually just while you were talking, I looked up Buffett 13F just to see if it was out. So I was like, I want to figure this out. What have they been selling? But no. So there you go.
Yeah.
Well, I'll have to wait. But yeah, that is interesting. I don't really keep up to date with his portfolio so much that I would know what one he's selling. But,
yeah, and I would imagine that because we don't know about this until the 13F, it must be a business that he holds less than 10% of, because he'd have to be under that reporting rule where you have to report it in a couple of days or something after you're doing.
Yeah, otherwise
trades.
we'd know already.
Yeah. So I guess we'll find out what he's been selling, and also what he's been buying as well during that period.
Yeah, true.
But the other
always like looking at the 13Fs for Buffett.
Yeah,
it's very interesting.
Yeah, it's very, very interesting. We get to see all of the big trades in and outs that he's making, and then also all of the little ones that he has, because they actually have quite a few really small positions that seem to be like he's just dipping his toes into a few businesses. And then obviously a very small number of them end up being really big investments. But yeah.
Well, the portfolio's got 52 stocks in it.
Right. Yeah. So a lot.
And I think only the top 10 have more than 1%.
Right. Okay. That makes sense.
I think like after maybe it's a bit more than the top 10, but very soon after that, you're getting into positions that are less than 1% of the portfolio.
And Apple's like 45% of it.
Apple's a huge chunk of it. Yeah, I might look that up, but it'll tell us last quarter's result. I'm just navigating there now. Warren Buffett. Let's have a look. 35% Apple, 11% Bank of America, 10% Coca-Cola, 7% American Express. If I scroll down, there are, what number is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 stocks that have more than 1% weight in the portfolio.
Right, okay. Yeah, that makes sense. Interesting.
Yeah, so he's got a lot of, 0.1, 0.2, 0.3%, etc.
Yeah. Very interesting. The other thing to mention on the cash flow statement is we can also see one stock that Berkshire was buying. They bought $5.1 billion of their own stock. So they did a substantial amount of share repurchasing. And I guess to put that number in some context, because just saying 5.1 doesn't really give us any idea, but the previous quarter was about, I think it was 1.7 billion or something like that, 1 point something billion that they did.
Substantially more.
And in 2019, it was about 4 billion for the whole year. So
it's substantially more now.
Exactly. And I think Buffett has been very strict on share repurchases. It's not a company, Berkshire's not a company that does.
It's not an Apple.
No, they don't repurchase stock all the time. They're not a Starbucks taking on a bunch of debt and repurchasing their stock, even though it's at all-time high. So they're very strategic when they repurchase stock. And Buffett's been clear on this. When he's repurchasing stock, it's only because he thinks it's undervalued. So clearly he thinks that it's the best deal that he can get right now. Or maybe not. Maybe we'll see on the 13F what else he's buying. With that, we can kind of see where his head is at in terms of the current market. But yeah.
Yeah, I'm keen. Well, I'm sure we'll cover it probably on next week's podcast. I'd be interested to see that 13F.
Yeah, definitely.
Yeah. Do all 13Fs kind of come out at the same time? I don't quite know the reporting of 13Fs.
Yes. So my understanding is they have 45 days after the end of the quarter to report. So I think the 15th of August is 45 days. So most of them wait until right at the end so that they get as much lead time. So that would make sense.
So we might have a lot to talk about next week.
Yeah. So the quarter would have ended at the end of June. And then, there would have been 45 days. So you would imagine that a lot of companies, a lot of funds are going to be reporting in the next couple of days their trades for the 3 months ending in June 30th.
Oh, very good. We'll have to pay attention to that next week.
Yeah, absolutely.
All right. Let's, you want to get stuck into a couple of Q&A questions?
Yeah, sure. All right.
Cool. I will ask you this one here.
Oh, okay.
how do you go about interpreting the 1 year, 3 year, 5 year, 9 year growth figures for from your revenue, EPS, equity, and cash flow for owners, and then applying them to get a growth rate to use in your discounted cash flow?
Oh, okay.
How do you go around looking at these different numbers? Because I mean, all the numbers are important to look at, but how does that then translate into how you decide on a growth rate for your various valuation measures?
Yeah, the first thing I think that's important to say is that you certainly can't just rely on looking at the past growth of a business to project into the future. Lots of businesses, most businesses in fact, they perform differently over 10-year periods. One 10-year period, they might grow at 8%. The next one, they don't grow at all, or they grow at 6%, or they grow at 12%. So when I'm ever looking into the future, it's never just extrapolating what has happened in the past, 8% growth in the past. Let's just make that go into the future. I'm thinking about their past growth in the context of their business. Do I think their business is stronger? Are they going to grow at a higher rate over the next decade? Or are they going to slow down? Or is it going to be a similar rate because they've been growing at that rate at a slow, consistent rate for a very long period of time? So that's sort of the context I think about that. But in terms of the past growth, what I'm mostly looking for is consistency to show me that customers are consistently coming back and in higher numbers. So really, I'm mostly using the past growth as an indication of whether the business has a competitive advantage. So whether it has something unique that will give me confidence that at the very least, they're not going to go away over the next 10 years. So that's really where I'm mostly using past growth, although it does often provide some insight into projecting future growth. But yeah, as I said, it's kind of one factor that you consider among other things, whether they're going to grow at a faster rate or not into the future. Usually I'm projecting that they'll grow at a much slower rate than they did over the previous decade, just to be conservative. That's usually
generally speaking. And it makes sense because the longer you grow, the harder, the bigger your company becomes and the harder it is to grow at the same rate.
Absolutely. And the other thing to mention is that the higher the growth rate is, the harder it is for them to maintain that over a long period of time. So for example, something like Facebook has grown at an extraordinary rate over the past 10 years. But for them to then replicate that again, given their size at the moment, is unlikely. You'd have to project that they're going to slow down from 30%, 35% per year down to something much slower. Whereas other businesses, they might be growing at 3 to 5%, and they've been doing that for the past 25, 30 years. So in those cases, it might make more sense to have a similar growth than their past 10 years. So it really just depends. It's kind of one factor that goes into other ones.
Yeah, generally speaking, though, I quite like to look at equity and free cash flow, or I guess the owner's earnings or the owner's cash flow, I guess, just because at the end of the day, that's what you as a shareholder actually get. Like the equity is you have all the company's assets, and then from that number, you take away everything that they owe to other people. And then after that, you're left with the equity, and that's what the owners of the business actually get. So you like to see what the owners own. You like to see that going up year after year. And you also want to make sure that obviously the owner's earnings is, the amount of cash that the company makes for the owners of the business during that year. So I guess I like to look at those two. But yeah, what you said is exactly right. You need to factor in all of them. Like it's obviously very complex. Like you don't want to be, I don't know, discount, free cash flow went up and, sales went down. It's like, oh, hang on, sales went down. So yeah, you need to look at all of them.
I think just be careful of being overly simplistic when it comes to estimating future growth.
Definitely.
There's a lot of, and I mean, I'm probably guilty of saying this in the past, where just saying, look at past equity growth. Or I know that Phil Town says, look at past equity growth or past earnings per share growth. It's too simplistic. That's kind of a good, I guess, baseline starting point just to get your head around what we're trying to do. But that's certainly not enough. And the more you understand about a business, the better you will be able to come up with a growth rate that is reasonable, but ultimately conservative, so you're very confident they're going to be able to hit that number. So
I was hoping you're going to bring that up. It all comes back down to your understanding of the business. That's it.
All right.
All right. Should we leave things there?
Yeah, sure. Thanks everyone for tuning in this week. And as always, if you have a Q&A question, if you have a Q for us.
If you have a Q and we have an A.
If you have one, head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and then leave your questions there. If you have any companies or I guess funds, investment funds that are releasing 13Fs next week or in the next couple of days, if you have any that you want us to check out specifically, you can also let us know about that. Thanks, Sharesight, for sponsoring this week's episode. And thanks, Brandon, for joining us as always.
Yay.
All right. And hope you guys have a great week. See you later, guys.
See you later.